the money velocity by definition is GDP over money supply, I think is what it is. Or
Yeah.
maybe it's money supply over GDP. It's some like it's one of those, it's like this huge agglomerative number, meaningless number, which is GDP, which is how much money is being passed around for goods and services in a given time period, over the money supply, which includes all the reserves in the banking system. So like, you're gonna count all the reserves in the banking system that are just sitting there in reverse repos, and then put that back on inflation. I mean, like one is the result of another, and you're just going in a tight circle here. Like what is money supply? Money velocity doesn't mean anything. It's just what we see because there's a whole bunch of reserves in the banking system that aren't being spent. But like that could change at any time if what was it that Zoltan said, that if they run out of oil, then all those reserves are going to have to come out. I don't know exactly how he worked it out, but like we have all this like monetary material and reserves that could come out at any time. We don't know how. And then what happens to money velocity? It just like
Yeah.
skyrockets. Well, will Russia accept gold for oil? I hope they do. I don't know if they will, but they haven't showed any indication that they're going to do that. But if you look at Zoltan's argument, it makes sense if Russia really understands that. But well, the argument against it, what I saw is, okay, so the U.S. is pinning Russian oil at 60, so fine. And then he says that, so if Russia accepts $60 is about a gram of gold, let's just say. And so if Russia says, okay, we're gonna sell a barrel for a gram of gold instead of $60, they're kind of obeying the price control. But then he says, okay, so what if they offered 2 barrels for a gram of gold? Then what would happen is people would buy gold with the dollars to get oil at half price. And then the arbitrage between gold and oil would even out, and you'd have gold trading at about twice the level. So the argument is, so why wouldn't Russia just sell oil for 1 gram of gold or $60 and then buy gold with the dollars at twice the amount of gold that it could buy, and then it just make money
Yeah.
that way? They don't want dollars because they can't spend them for political reasons. But even if they could, let's say they could spend those dollars by offering a discount on oil for gold, they would be increasing, Zoltan says this, they would be increasing the value of their own gold reserves in dollar terms anyway, because they already own a bunch of gold. And the way I look at it philosophically in a monetary philosophy sense, like what is the money when you're talking about gold versus dollars? Gold is the money, dollars is the substitute. And by offering a discount on oil for gold, then what they're doing is slicing the dollar and destroying its purchasing power for everything. Like if gold goes to $3,600, doesn't mean that the price of everything doubles exactly. It doesn't work like that. But the prices of everything tend to go higher, very quickly. Exactly how high depends on other things. But I'm not into
Yeah.
predicting exactly
Yeah.
what. It's not really a thing that you can say this is what it is and you can measure it. What you can do is you can look at prices and sort of guess what's going on, but there's no measurable thing called a price level. What there isn't even really a measurable thing called a money supply. I mean, you can get a little bit more exact or a little bit more precise into what money supply is, but you can't even define what we're talking about the currency, but you can't really define what the currency supply is even, because different people use different kinds of things as a collateral for their currency, and you can't really measure these things either. So once you accept that, then you can look at the CPI and say, oh, it's rising or it's falling, and it's like it's a very loose effect, very very far removed after effect of what is going on at the spigots of the money supply, and even that isn't even exact. So when the money supply expands, the first things that are affected are the capital prices, because that's at the top of the structure of production. So you have stock market, real estate, and commodity inputs, right? So because that's the beginning of the capital stage. So when the money supply goes up, all these prices go way up, and the last things to be affected are the consumer prices, because they were produced a long time ago. right? The structure of production is so long that the stuff you see on the shelves now came from input prices that are maybe 6 months to a year old, or however long it takes. I don't even know. So there's a lag. So you're going to see the rising stock prices where the money goes in first. And then maybe a year later or so, the consumer prices are going to be affected by the capital prices that are being affected now. There's a lag. So, but it's the same thing on the way down. On the way down, when they stop printing money, the first things to fall are the capital prices, the stock market, which is in a downtrend since, even before the money supply stopped being printed or expanded. And then you have the falling housing prices. We're seeing that very strongly now. We have all these assets falling, and the commodity inputs of the capital space should also be falling hard, but they're not. They were falling hard in 2008. The fact that they're not falling hard is a very worrying signal. What happens to them when they start printing again? So what you have is, when you have the falling assets, the falling bonds, and all these assets on which the bank balance sheets are based, and they're falling fast. So eventually you end up with some kind of a credit crisis in the mechanics of the monetary system. And then the Fed has to print again. It doesn't matter what's happening with the consumer prices. And theoretically, in theory, yeah, the Fed could say, okay, we're going to let it all topple, and we're going to let the banks collapse. We're not going to bail anybody out, and we're not going to print any more money. We're just going to keep the money supply at the same level for like 5 years. If they theoretically did that, then yeah, consumer prices would fall, and it would be like the 1930s. Just from what I saw from when we were around the 1670, 1620 range, if we were going to break 1670, which we did, then it should have broken down, but it didn't.
That's the longer term one here. When we were down here, it wasn't looking very good. But I guess we could maybe call that now a bear trap. People went short. They're thinking, oh, gold is going to 1,000. And then it just reversed and is now really moving higher. So we're going to move on here. Gold and silver actually encouragingly stayed pretty firm. I thought that was a good signal.
That looked like a lot of selling on strength to me. It looked like day traders or algorithms traded the CPI, bought, and then a lot of people who wanted to exit positions on that opportunity did it quickly.
The reason CPI has dropped in the US is because they've been hoarding the petroleum reserves, and that's made oil look cheaper, of course. To me, it seems like, let's say someone that is overweight or obese, instead of going on a diet, they go and have liposuction. It doesn't really solve the problem because they'll put it all back on.
You have to kind of realign. If you want to think about this correctly, and there is a correct and an incorrect way to think about it. If you want to think about it correctly, you have to go into the Austrian school, and I would recommend reading Rothbard. His main, I would say, Austrian school Bible would be Man, Economy, and State. And there, and in many other places, he says there's no such thing as a consumer price level.